The last time the banks slammed the brakes like this, the economy flipped upside down. And now in 2025, it's happening again. I'll break down why banks are cutting back, what it means for your wallet, and how you can protect and even grow your money during this shift. Let's jump in. As always, I would really appreciate it if you like and if you subscribe to my channel. So, why do lending standards even matter? It all comes down to the evolution of a credit cycle. And so I want you to understand what the key points are of a credit cycle, which really begins with leverage. Leverage is another word for debt. And what this means is the very first piece of a credit cycle to really start rolling is if there is too much debt that starts building in a bull market, meaning in an up market. That then means that if there is so much debt, central banks, they start tightening policy to try and make people borrow less. Because if there's less debt, that means the economy is probably less likely to burst. In other words, the bubble won't burst. The tightening means it's going to counteract the overheating meaning over an excess borrowing. That ultimately then leads to credit conditioning, meaning the availability of lending and borrowing and debt actually begins to tighten, which means businesses can't just go out and access money, which means businesses just can't expand as they used to, which means that ultimately the overall economy, meaning businesses, are going to tighten, restrict. They're probably not going to hire that many people anymore, right? It really trickles down to you and me, the end consumer, if there are tightening conditions. And then ultimately, that means companies begin to cut costs, like we were saying, eventually cutting labor. And then ultimately that means default. So businesses and people being able to pay back the debt that they borrowed are going to default. They're not going to be able to pay it back. So that's when defaults spike. And that is the worst part of the ultimate credit cycle. So that's just an understanding of what it means. Here's another chart if you prefer to learn this way. It really all starts with how easy credit is available, right? So how easily can you or a business grab debt? And typically when the goal is to make the economy expand, that's when the Fed lowers interest rates, which lowers the cost of borrowing, which encourages businesses to access this debt that is now cheaper. And when businesses access cheaper debt, that ultimately means they're going to expand, right? By either investing it in innovation, in technology, infrastructure, and also jobs. So that ultimately helps grow an economy. That's the good side. But if there is too much debt that's available, that leads to rising debt levels like we just spoke about. That also leads to asset price inflation. So like maybe businesses are investing too much in technology, which makes them look like they're overvalued. And in reality, maybe there's not that much substantial evidence that they are actually worth that value. It could also relate to real estate prices, etc. Overextension, meaning there's just too much debt. And then finally, it goes back into the negative territory where if there's too much debt, then banks tighten, and that tightening ultimately leads to an economic recession. And then it just starts all over again. It's a cycle, and that's the point of it. It will go up and it will go down. So how does this relate to you? Ultimately, and a very key point here is that the U.S. is a credit-based economy. It's not just based on cash. What do I mean by that? I mean, if you have $10 in your bank account, okay, in your debit account, you can only spend $10. But if you have a credit card, what does that mean? Typically, credit cards give you something called a credit, hence the word credit card. Credit typically allows you to borrow much greater than the $10 that is actually in your bank account. So for example, my credit card has a limit of $5,000 or $7,000. I don't know because I don't use that much credit. But there are credit cards that allow you to borrow much more than what's in your bank account. Why? Well, if you want to address that question mark, the reason why is because it leads us back to this graph. America is very much a credit-based economy. So they're trying to stimulate the economy, trying to stimulate activity by giving out credit, right? Which means debt, basically. So people and businesses have access to this debt, which ultimately leads to business expansion, people buying mortgages. It really helps the economy get along. But sometimes, just sometimes, that also leads us into recessions. I'm talking about the dot-com bubble. I'm talking about the great financial crisis, the GFC of 2008. And yes, I'm also talking about the most recent crisis, right, in 2020. To be fair, that was COVID fueled, but also partially because a lot of people did have credit as well. So what you can see here in this graph, consumer credit has cooled. What does that mean? It means that banks aren't really that happy and aren't really giving out debt as easily as they were in the past. So if you want to look at the total credit given, so the total debt extended to individuals, you can see a very clear trend line, which is moving downward. Yes, to be fair, it is in 2024, but that trend line has persisted. So what does it mean if you have more credit, right? So if we're looking at maybe the peak here, more credit means more spending. Again, we are a credit-driven economy. More spending means business profits, and then that ultimately means stock growth, which means more money in everyone's wallets. That's what we want, right? But not too fast. Too much credit, like we were talking about earlier, means bubbles, right? So there will be bubbles. We just identified a few. And that is ultimately when there might be a bubble forming, or when we're on the precipice of a bubble forming, banks start to recognize that and want to pull back, which ultimately means there will be a slowdown in the economy, or could be a slowdown in the economy. So here's a little bit of writing on credit booms and asset price bubbles. For the sake of brevity, I'm going to skip over this, but feel free to pause the video and review. So what are some lessons from history? I mean, I love this because, history really does help teach and inform us what could happen in the future. While history might not always repeat itself, it certainly does rhyme in some instances. So it's important to stay up to date. So first and foremost, when a bubble inflates, that means more loans, right? That is typically also a result of increased loan activity, increased credit activity, credit lending. So when there's too much credit lending, like we spoke about, there is the chance that a bubble can pop when lending tightens, and that is a result from the bank. So to be very crisp and clear, a credit bubble really does occur when there is excessive lending and borrowing in an economy. And then that leads to inflated asset prices because so many people have access to debt, right? If you have access to unlimited amounts of debt, that means you can actually borrow so much money. You could buy, a Lamborghini. Any person could buy a Lamborghini. If there's so much demand for a Lamborghini, well, the price is going to go up of a Lamborghini, right? If there's so many people wanting it, well, then Lamborghini, the company, is going to take advantage of it and be like, all right, if there's a couple million people wanting to buy our cars, and if they have access to so much debt, why not raise the price of the car if the people can get access to the debt? Similar reason, or at least a theory, why student loans have increased so much, right? If people can get unlimited access to student loan debt, then schools, in theory, could continue increasing the price or the cost of school and tuition, knowing that students can get unlimited access to unlimited debt. And then that ultimately pushes the price of the asset, in this case, the education, higher and higher. So at least from an economic theoretical standpoint, this certainly could make sense, right? So that ultimately leads to unsustainable debt levels, and then ultimately the credit bubble bursts. And examples of credit bubbles include the mid-2000s. We already talked about this, the dot-com bubble, the great financial crisis, right, in 2007, 2008. And you can see this here as well. You can see a couple of additional bubbles here, biotech bubble, AI bubble, which arguably some folks agree that we are in, so others disagree that we're in that. But, I would love to hear your comments if you want to drop some in the comment box. But yeah, the whole reason why there are credit bubbles is because there was easy access to credits. For example, in 2008, banks actually bundled risky loans. They bundled these risky loans. Why? Because the banks actually, it was pretty smart on their part, unfortunate to the rest of the economy because we suffered through it, right? The consequences. But the way banks did this is they thought, okay, we're going to extend easy credit to anyone that wants a mortgage. We're not really going to follow through on these really strict requirements, like what are their income levels, how stable is their income, are they cyclical, seasonal workers, etc. We're not even going to worry about that. We're just going to give out the credit. Why? Because the banks were able to originate these loans ASAP. And then the banks essentially bundled these loans that were generally riskier because it was so easy to access these loans. They bundled them and they sold them off. So when they sold off these loans, essentially they got the profit now by generating and originating the mortgage, but they essentially caused problems down the road for everyone, the entire economy, by selling them off and washing their hands basically and saying, all right, this is not my problem anymore. I sold it. I made the profit. Other people can worry about it. Unfortunately, everyone worried about it. And so ultimately, when banks started tightening the credit, the mortgage origination requirements, that's when the bubble burst, and that caused the 2008 crash, right? So ultimately, again, this leads to the main thought process that credit flow really does drive booms and busts, especially in the American economy. So what's actually happening in 2025, and how does this relate to your situation? So before I continue, I just want to take a pause and say, if you find this information interesting, I would really appreciate it if you go to the pinned comment on the bottom of this video and sign up to my newsletter. That would be amazing. There will be a lot more tips and tricks in the newsletter. With that, let's keep going. What's actually going on in 2025? So here, I want you to take a look at this graph from the Federal Reserve Bank in Missouri, St. Louis, Missouri, and it is the net percentage of domestic banks, so U.S. banks that are tightening standards, so in other words, making it more difficult for people, specifically for commercial and industrial loans to large and middle market firms. So these are part of the heartbeat, or a large part of the heartbeat of the American economy. And this graph shows how easy or not easy it is for this industry, right? Middle market and large market firms who are looking for commercial and industrial loans, which really help, grow our economy, to access these loans. And as you can see, there has been a pretty steep drop off in 2024 and beyond. Now, again, compare this, there is a steep drop off during the early 2000 dot-com bubble. There's a very steep drop off in the great financial crisis. Great drop off as well in just past COVID. So yeah, there's another drop off, and it's pretty steep, I would say. Of course, that doesn't mean that there is going to be a recession. However, it is certainly a warning sign, right? Again, history does not repeat itself, but it certainly rhymes. So just something to know. I think it's important to know all the different facts and then create your own conclusion afterward. So the next thing is talking about the Federal Reserve. How does the interest rates impact the banks? So oftentimes, if the Federal Reserve lowers or cuts interest rates, and in this case, you can see the graph predicting a 98% interest rate cut. This is before September 17th, of course. If you are watching this after September 17th, then you would know that they actually did cut by 25 basis points. But in any case, when the Federal Reserve cuts rates, then that means that borrowing is cheaper, which ultimately signals that companies can go and access debt at a cheaper cost. However, what's the confusion here? And I'm going to skip over this. The confusion is that the Fed is essentially pushing on the gas because they're cutting rates. They're making debt cheaper. But the opposite is happening with banks. Banks are actually pushing on the brakes. Banks are restricting loans. They're restricting access to credit. And that is the confusing piece. You can't really go down the highway going with the gas and the brake at the same time. I mean, sure, yeah, you might accelerate a little bit, but your engine's going to break at some point. So does this foreshadow a potential recession? I don't know. I don't think anyone knows. But the thing that I do know is that this can be a little bit of confusion in the current economy. And also, very quickly, to show you that right now, the U.S. central banks, they are really kind of worried about what's going on or what would happen in the future, because they are holding back, right, the restrictions, the credits. So with that, let's keep going. Since 2024, some big picture items. Since 2024, banks are getting stricter on loans. We've seen that. 2025, tightening is accelerating. About 12.5% of banks are actually tightening these standards. However, the Fed, on the other hand, is really worried about jobs. We've seen a couple of revisions of the job market, of the labor market, right? And it's actually been revised lower in terms of a lower number of folks are actually getting access to jobs, which then ultimately leads to the Fed considering cutting rates. And that ultimately leads to a conflicting signal, which is what we just talked about, the gas and the brake metaphor going down the highway. Now, what does this mean for you? So there's 3 categories that I would kind of focus on. First, spending. Second, jobs. And third, investing. This is the most important thing when it comes to financially protecting yourself in case of a potential pullback, economic recession, or just a slowdown in the economy overall. So the most important thing, I think key points here from this are, 1, there is a likelihood that there will be less available credit out there, right? So whether you have a small business, whether you yourself are an individual, you're trying to get credit, it's probably not going to be as easy to access, which ultimately leads to slower spending in the economy. And knowing that we're a credit-driven economy, there might be an economic cooling. And this likely would directly impact, initially at least, small businesses, and that can ultimately impact hiring. So labor and small business growth is likely going to slow down. For individuals, it's probably going to be tougher to qualify for mortgages, personal loans, or credit cards because of that tightening standard from the banks. However, there are possible investment opportunities if asset prices dip. What I mean by that is if they do dip, the asset prices, assets being anywhere from real estate to stock prices, for example, you could certainly use any money, any cash that you have saved as dry powder and essentially insert it into the stock market to buy prices or to buy assets at very low prices. And something I do want to share with you here, this chart I think does a really good job explaining that while it is certainly a possibility for us to go into a bear market, into a recession, there's no need to panic over it because as you can see, which color is much more prominent on this chart? I would say it's blue, right? There's a lot more blue than there's red. And what does that mean? It means that the chances of a bull market coming are very likely. And it also means that if there is a potential for a recession or a bear market, it's probably not going to last that long like a bull market. The longest bear market here to date is after the Great Depression. And let's hope we don't have a repeat of that. And there are multiple triggers and multiple safety nets built into the system now. And in part, thanks to learning from the Great Depression in 1929, 1930, and 1931. So again, hopefully this also kind of helps calm you down in case you were worried about your financial situation. Sure, no one wants to go through a bear market. Unfortunately, it is part of the economy. It is just part of the cycle. But again, if there is a bear market, chances are it's going to go back up, the stock market, and likely not going to last as long in the bear market as it will in the bull market. So hopefully this helps. Now, here's how you can prepare and profit. First, I would build a cash cushion. Again, this is like your dry powder, your emergency savings fund to insert into the market in case you do see asset prices dip. It's important to reduce risky debt. So risky debt, for example, for me at least, is something like credit card debt, right? Like anything that's pretty high interest. Let me go back here. So anything that's greater maybe than 10% interest. That is what I would consider risky debt, and I would try to get rid of that, or at least pay more toward that debt than maybe just paying the minimums. I would also consider just investing in simple stuff, right? Keep investing in simple stuff. So if you have been investing in the S&P 500, at least for me, I've been investing in the S&P 500. I've been investing in pretty simple, straightforward ETFs like VOO, for example. I'm just going to keep doing that. I'm not going to complicate my life. I'm not going to overcomplicate my portfolio. I'm going to focus on the long term because I still have a long ways to go before retirement. And I'm going to focus on low-cost index funds. That is going to be my steady state. My DCA, I'm going to dollar cost average into that. It's automatic, out of sight, out of mind, and I'm not going to worry about it. And then I'm going to stay liquid for opportunities. And this goes back to building a cash cushion. So if there is extra cash on top of my emergency savings fund, or if I'm comfortable dipping into the emergency savings fund a little bit to insert into a down market, I'm absolutely going to do that. The most important thing is start building wealth ASAP. Start building it today. Now, if you found this video helpful, please like it and share with others to help them. Subscribe to my YouTube channel. It's at _MMW. Don't forget the underscore. And then finally, join my newsletter for more exclusive tips. That is pinned in the comment below. Your bank accounts will thank you later. Bye-bye.